IVM.
Imagine this. You're at a buffet and the chef asks, would you like to sample everything or are you just here for the dessert? Now, think of the same way for your investing as well. Some investors want a bit of everything while the others prefer to concentrate on specific flavors. That's where sectoral funds come in. They allow you to focus your investments on specific sectors, whether it's tech, pharma, or energy. It's all about putting your money where your forecasts or beliefs lie. Welcome to Finance Flashback, brought to you by ICICI Prudential Mutual Fund. I'm your host Paritosh Anand, and today we're diving into the world of sectoral funds. Think of them as specialized investment teams, zeroing in on specific industries for investors who are ready to go all in. So, what makes sectoral funds stand out, and how can lessons from the past help us navigate this niche investment space? Stick around as we dig into history and finance to uncover smart strategies for the future. Let's rewind to the mid-15th century. Johannes Gutenberg in Mainz, Germany introduces printing press, a revolutionary invention that changed the game. By using movable type, his press could mass-produce books quickly and affordably. Fast forward a few decades, and by the year 1500, over 1,000 presses were operating across Europe, printing more than 200 million books. This single innovation, ladies and gentlemen, played a massive role in spreading knowledge during the Renaissance and helped spark the Age of Enlightenment. As Mark Twain once remarked, what the world is today, good and bad, it owes to Gutenberg. So, what does this historical example have to do with sectoral funds? Just as Gutenberg's invention revolutionized the printing industry, sectoral funds can offer compelling opportunities when a specific industry takes off. Focusing your investments on one sector gives you the chance to tap into its full potential, much like how the printing press unlocked the demand for affordable books. In both cases, whether it's investing in a booming sector or capitalizing on a revolutionary invention, the key is recognizing and seizing opportunities at the right moment. Now, let's fast forward to another pivotal moment in history, the California Gold Rush of 1848 to 1855. Gold was discovered at Sutter's Mill, and soon after, waves of people rushed to California, hoping to strike it rich. These individuals, famously known as the 49ers, were all eager to dig up gold and secure their fortunes. But here's the interesting part. While many did find gold, some of the biggest fortunes weren't made by the miners. Instead, they were made by the savvy entrepreneurs who catered to the miners. Merchants, tool makers, hoteliers, and even laundry service providers saw massive profits as they supplied goods and services to those seeking gold. The gold rush not only led to rapid economic growth, but also played a key role in shaping California's lasting appeal, turning it into the golden state in more ways than one. Let's rewind to another pivotal moment in history, the railroad boom of the 19th century. During the mid-1800s, railroads completely changed the transportation landscape in both the United States and Europe. Suddenly, goods and people could be moved across long distances at speeds previously unimaginable. Railroads became the lifeblood of the economy, connecting industries, towns, and markets. As the rail networks expanded, there was an immense demand for steel, coal, and labor. Investors who focused on the railroad industry saw enormous returns as the sector grew. It was a golden age for railroad companies, and many people became wealthy by investing in this transformative industry. This industry didn't just create wealth, it helped lift an entire class of people out of poverty, giving rise to the American middle class. Just like the railroad boom, sectoral funds let you invest in industries with high growth potential. By focusing on a specific sector that is set to expand, whether it's transportation in the 1800s or the technology today, sectoral funds can offer an opportunity to ride the wave of growth within that industry. Investing in emerging industries with high growth potential, like the automobile sector back then, can yield significant returns. But remember, staying on top of the industry trends is key. No investment is without risks. And when it comes to sectoral funds, one of the biggest risks is volatility. The performance of a sectoral fund relies heavily on the success of that sector. So, if that industry hits a rough patch, the fund might underperform compared to the broader market. But keeping a few things in mind can help you make the most of your investments in these firms. Like, for example, number 1, know your sector. Understand what drives growth and the associated risks. For example, in the pharmaceutical industry, drug approvals and patent protection are the key factors. Number 2, diversify within the sector. Even though sectoral funds focus on a single industry, spread your investments across various companies in that sector. This reduces the risk of putting all your money into one company. You can do so by investing in a sectoral mutual fund, which are equity schemes that invest in a specific sector of that economy. For example, an IT sector fund would only invest in the IT stocks basis careful observations in the market conditions. And number 3, most importantly, stay informed. Keep an eye on the trends, regulation, and economic changes that might impact your chosen sector. Technology, policy shifts, and consumer behavior can all have significant effects. In summary, sectoral funds can provide a great way to tap into the growth of specific industries. Whether it's the automobile boom, the gold rush, or the rise of oil, finding the right sector at the right time can lead to better returns on your investments. Thanks for tuning in to Finance Flashback. This is Paritosh signing off. Don't forget to subscribe or follow to the podcast so you can keep up with the past lessons that can guide your future financial goals. Until next time. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.